An estimated 1.2 billion people in low-income countries around the world still lack access to basic electricity. Renewable energy, including small-scale wind, solar, and hydropower, can help fill this gap without increasing the world's emissions. However, despite the promise and opportunity of small-scale renewable energy, financing options in these markets are often not well aligned with the needs of these projects.
Small-scale renewable energy is very interesting from an energy access perspective because it allows banks and developers to develop projects at a much more limited risk profile. This is very important in certain countries. For example, we looked at Nepal. Nepal has very high potential, in fact, amongst the highest in the world, yet it struggles with persistent electricity shortages. A lot of its cities go without power for between 12 and 14 hours per day. And the reason for that, the reason why investment hasn't happened is because the financing conditions aren't right. So this instrument provides a solution to that and could substantially increase the investment in small-scale renewable energy.
Looking at the financing conditions that small renewable energy projects face in many developing countries, it's actually a miracle that these projects are ever built. The financing conditions are highly inappropriate. It's fairly common that you see projects being financed with tenors of 5, maybe 7 years, and financing terms in dollar, and interest rates in dollar, which are about 10 to 12%. And a project really has to be highly profitable to make sense even under these financing conditions. And thus a lot of projects which are in more remote areas of a country do not get built up. The small-scale renewables financing facility aims to systemically improve financing conditions for small renewable energy projects in emerging markets.
The small-scale renewable financing facility incorporates two innovative and complementary financing approaches: a discounting facility that would refinance projects post-construction, and a mezzanine facility, which would provide construction financing. During the first stage of implementation, a pilot would focus on the discounting facility, in particular in target markets that include Nepal and the Indian Himalayan states, Indonesia, and Peru and Colombia.
The discounting facility operates on a very simple premise. A renewable energy project that is built and has a power purchase agreement is actually not very risky. For solar, wind, or hydro, there is no fuel price risk, limited technology and operational risk, and if a PPA is present, reasonable revenue certainty. If these risks were recognized appropriately, financing could be offered that would significantly improve upon current conditions, and that is what the discounting instrument tries to do.
The impact of such a discounting facility would be significant. A $100 million facility would probably need a $10 million donor first losses to prove the concept, and a $90 million investment from DFIs or commercial sources. The impact of such a facility could be fairly significant depending on the markets and the financing conditions in the respective markets. Such a facility could release up to $80–90 million of equity currently tied up in existing projects, which could result in $250–300 million of new investment.
This facility could potentially mobilize investment of up to 170 megawatts in countries like Nepal, which currently suffer from electricity shortages and a lot of people lack energy access. Just to give you an idea of how big of a number that is, that's almost 1/4 of Nepal's current electricity generation capacity.
I think in energy finance there's a potential break in paradigm. For about 100 years, bigger was always better. And so everybody was looking at big projects and nobody wanted to look at small projects. I think at this point we're looking at a breaking paradigm with, in particular PV, small-scale projects have become extremely viable.